So if you add up the cost of the house you live in and the cars you drive over your entire life, that combined number is actually still smaller than the single greatest expense you will ever pay.
Which is taxes.
Taxes, exactly. Welcome to this deep dive. Today, our mission is to translate a mountain of really dense financial jargon into a masterclass for you on how to legally maximize your wealth.
And, protect your assets and avoid those devastating traps that ruin new businesses every single day.
Right. We're going to navigate the high-stakes world of LLCs, tax write-offs, and break down the massive recent tax code updates. Specifically, I'm talking about the 2025 One Big Beautiful Bill Act.
It is an incredibly dynamic landscape right now.
Yeah.
The rules of the game have fundamentally changed for anyone operating a business.
Yeah.
And because taxes are siphoned off invisibly, paycheck by paycheck, we rarely stop to calculate the sheer magnitude of what's happening beneath the surface.
Okay, let's unpack this, because before we get into the advanced ninja-level tax strategies, we have to start with the absolute foundational rule of having an LLC in the first place.
Absolutely.
I mean, you'd be shocked how many seasoned entrepreneurs accidentally destroy their own company on day one just by buying a sandwich.
It happens constantly. People set up an LLC for limited liability protection. The whole point is to build a fortress, so if the business gets sued, your personal house and your savings are untouchable.
But then they commit the cardinal sin, right? Commingling funds.
Exactly. The cardinal sin of business ownership.
So say you're at a coffee shop meeting a client. You forget your corporate card, so you just swipe your personal debit card. What's the big deal?
Well, the big deal is that a judge will look at that single transaction and say, look, this isn't a real separate business. This is just an alter ego of the owner.
Oh, I see.
It's a legal concept called piercing the corporate veil. The moment you commingle funds, a judge can strip away your LLC status entirely.
Leaving your personal assets completely exposed.
Exposed to business lawsuits, yeah. You instantly lose the exact protection you paid to set up.
To prevent this, you absolutely need an EIN, an employer identification number. Think of it like a social security number for your business.
That's a great way to put it.
You take that EIN to the bank, you open a dedicated business checking account, and you basically build a wall. Every dollar of revenue goes in there, and every business expense comes out of there.
Precisely. Because it creates a pristine paper trail. Without that separation, you aren't just risking a lawsuit.
Right.
You're making it impossible to get business credit or loans down the line. I mean, banks want to see a clear, unpolluted history of business revenue, not a tangled mess of grocery bills and vendor payments.
So we have that wall built. We've legally separated the business from our personal lives. Now we need to figure out how to use that separation to shrink our taxable income pie through the art of the write-off.
This is where understanding the underlying logic of the Internal Revenue Code becomes incredibly lucrative. There are two competing statutes you really have to balance. First, you have IRS Section 162A. This section states that you can deduct all expenses that are ordinary and necessary for your trade or business.
Ordinary and necessary. That sounds incredibly broad. I love the word necessary.
It is broad, but it's immediately challenged by Section 262A. That one strictly states that inherent personal expenses are never tax deductible.
Ah.
The tension between those two rules is where all the confusion and, honestly, all the opportunity lies.
Wait, hold on. If I have to wear a high-end tailored suit to meet my wealthy clients, surely that's a necessary business expense, right? I can't show up in sweatpants and expect to close a deal.
You'd think so.
Section 162A, ordinary and necessary.
You wouldn't be the first person to try that exact argument in court. Let's look at a real-world scenario that set the precedent here. Barnes versus the IRS commissioner.
Okay.
In this case, a Ralph Lauren salesperson was actually required by their employer to purchase and wear Ralph Lauren clothing while working on the floor.
Well, that seems like a slam dunk. It's literally a mandatory job requirement.
And yet, the court ruled in favor of the IRS.
Wait, really?
Yeah, they disallowed the clothing write-off completely. Why? Because the clothing was suitable for general, everyday wear. It had an inherent personal use.
Oh, I get it. Because if they let you write it off, everyone would just buy their whole wardrobe through their LLC.
Exactly. Think about the IRS's logic. It would be an administrative nightmare and a massive loss of tax revenue.
Okay, so the fancy suit is out. But there are brilliant loopholes around this, right? Like clothing only becomes deductible if it's explicitly branded.
Yep.
Like physically embroidered with your company logo, which makes it a promotional expense. Or if it's highly specialized, like a theatrical costume or protective safety gear.
Exactly. You have to remove that inherent personal use factor, and this logic applies across the board. Take meals, for instance.
Right, because eating is an inherent personal expense. You have to eat to stay alive.
Exactly. But if you're eating with a client actively discussing business, it suddenly crosses into Section 162A territory, and it becomes 50% deductible.
And if you're throwing a holiday party for your employees, that meal is 100% deductible. It's all about the context. Same with your car.
Yes.
In 2025, the standard IRS mileage rate is 70 cents per mile. So if you drive your personal car to a client meeting, every mile is a 70-cent deduction for the business.
Right, and you can choose between that standard mileage rate or the actual expense method. That's where you write off a percentage of your gas, insurance, and vehicle depreciation based on how much you use the car for business.
Oh, nice.
But here is a crucial mechanical rule you cannot mess up. If you start with the actual expense method, you cannot switch back to the standard mileage rate later for that same vehicle.
Wait, why not? Why does the IRS care which method I use year to year?
Because the actual expense method heavily leverages vehicle depreciation in the first year.
Wow.
You're taking a massive upfront deduction for the dropping value of the car.
I see.
If the IRS let you switch to the standard mileage rate the next year, which, by the way, also bakes in an allowance for depreciation, you would essentially be double dipping.
Got it.
Yeah.
You'd be deducting the same lost value twice, so you are locked in.
Exactly, locked in.
That makes total sense when you look at the mechanics. Now, another incredible strategy we need to talk about requires zero new spending. It's using Section 179 to legally convert things you already personally own into business assets.
Oh, this is a fantastic lever to pull. Say you bought a personal laptop a year ago. If you start using it more than 50% of the time for your business, you can deduct its current fair market value.
Just right on your taxes.
Yep, multiplied by your business use percentage. You just have to document the exact date it was placed in service for the business.
Wow. So we've established that context is everything when deducting expenses. But what happens when the business actually generates a perk for you personally while paying those expenses?
Like what?
Let's talk about credit card points. If I use a business credit card to buy servers or inventory and I rack up thousands of dollars in cashback rewards, do I have to claim that as taxable income?
What's fascinating here is the IRS's official stance. Currently, they view credit card points and cashback rewards as a rebate, or like a retroactive discount on a purchase, not as taxable income.
A rebate, really?
Yes. If you buy a $1,000 flight and get $20 back in points, the IRS just views it as if you paid $980 for the flight.
That is wild.
Furthermore, they've explicitly stated that tracking the flight
for personal use is a completely tax-free loophole. The IRS basically saying, we're too busy, keep the points. I love it.
It's a great perk.
Okay, so we're starting to see how to shift expenses. But let's take this to the next level with one of the most powerful specific loopholes in the entire tax code. It's called the Augusta Rule, and it is the ultimate home write-off.
Officially known as IRS Section 280A, the Augusta Rule allows you to rent your personal home to your own business for up to 14 days a year, completely tax-free on the personal side.
While the business gets a massive deduction.
Exactly.
I want to pause on the name for a second because the history of this perfectly explains why it exists. It's called the Augusta Rule because residents of Augusta, Georgia lobbied the government for a tax loophole.
Right, for the golf tournament.
Yeah. Every year, the massive Masters golf tournament comes to town, and residents wanted to rent out their homes to wealthy attendees for those 2 weeks without getting hammered by income taxes.
So the government created this 14-day tax-free window.
Exactly.
Yeah.
But you don't have to live in Augusta, and you don't have to rent to golf fans. You can rent to your own business.
Let's look at a real-world scenario to see how the math works. Take an entrepreneur named John. John needs to host monthly shareholder meetings, or maybe he needs a location to shoot promotional videos for his company.
Sure.
He calls around and finds out that renting a comparable space, like a hotel conference room or an upscale Airbnb in his area, costs $500 a day. So John rents his own house to his LLC for 14 days, spread out over the year.
So the business pays John $7,000. For the business, that is a legitimate $7,000 operational write-off, reducing the company's taxable profit.
Right.
But for John, personally, he doesn't have to report a single cent of that $7,000 as taxable income. If he's in the 22% tax bracket, he just saved over $1,500 in taxes, legally moving money from his right pocket to his left pocket.
It's a brilliant mechanism, but what's fascinating here is how strictly you must adhere to the requirements to survive an audit. You cannot just invent a number.
Yeah, they'll catch that.
You must have a separate legal entity, like an LLC or S-Corp, not a sole proprietorship. There must be a legitimate business purpose for the rental.
Right.
And you must prove the fair market rate by saving actual quotes from local hotels or screenshots of comparable Airbnbs on those specific dates.
You actually have to draft a formal lease agreement between you and your business too, right?
Yes. And the business has to physically transfer the funds from the business bank account to your personal account. You can't just do it on paper.
Good to know.
At the end of the year, the business issues you a 1099 form for the rent paid, which you report on your personal taxes and then explicitly back out using Section 280A.
Wow.
And here is the absolute hardest rule. It is a 14-day cliff. If you rent it for 15 days instead of 14, the exemption vanishes and the entire amount becomes taxable, every single dollar.
Do not cross the 14-day line. Got it.
Yeah.
Okay, so we're shrinking the taxable pie with all these deductions. We're lowering the profit on paper. But this raises a huge question.
What's that?
Let's say I've done all my write-offs and my LLC has $100,000 of profit left over. What does this actually mean for my bank account? Can I just leave that money sitting in the LLC checking account for a rainy day and not pay personal taxes on it?
This is perhaps the harshest reality check for new business owners. A standard LLC is what the IRS calls a pass-through entity.
Okay.
It does not matter if you leave $100,000 sitting untouched in the business checking account or if you transfer it all to your personal account to buy groceries. The IRS doesn't care. They look at the total profit the business made at the end of the year, and that entire amount passes through directly to your personal tax return.
Wait, hold on. Let me make sure I understand this. If my business profits $100,000, but I only take an owner's draw of $40,000 to live on, and I leave $60,000 trapped in the business bank account, you're telling me I have to pay personal taxes on money I never actually brought home?
That is exactly what I'm telling you. Uncle Sam wants his cut of the total pie, whether you ate it or left it on the counter.
Ouch.
And the most painful part of that cut isn't just your standard income tax, it's the self-employment tax.
The dreaded 15.3%.
Yes. That 15.3% covers your Medicare and Social Security contributions. Normally, if you're a W-2 employee, your boss pays half of that tax and you pay the other half.
Right.
But when you own the LLC, you are both the employer and the employee. You pay the whole 15.3% on your ordinary income, all the way up to the cap.
Which in 2026 is sitting around $185,000.
Exactly. So if your business profits $100,000, you are paying over $15,000 in self-employment tax before you even touch federal and state income taxes.
Which brings us to the ultimate pivot, the S-Corp solution. Once your business is consistently profiting over $50,000 to $100,000, you can file IRS Form 25553 to have your LLC taxed as an S-corporation.
Right.
How does this change the math?
It changes the mechanics entirely. Instead of paying that 15.3% self-employment tax on all your profits, the S-Corp allows you to split your income into two different buckets.
Okay. Bucket
1, you become a W-2 employee of your own business. You must pay yourself a reasonable salary for the work you do. And that salary is subject to the 15.3% payroll tax.
But bucket 2 is where the magic happens.
Precisely. Any profit remaining in the business after your salary is paid drops into bucket 2. It can be taken out as a shareholder distribution, and shareholder distributions are completely free of the self-employment tax.
Okay, let's do the math on this. If my business makes $100,000 and I determine my reasonable salary is $40,000, I pay the 15.3% tax on the $40,000.
Correct.
But that remaining $60,000, I can pull that out as a distribution, and I just saved 15.3% on $60,000. That's almost $9,000 directly back in my pocket just for filling out a form.
That is the immense power of the S-Corp. However, if you're listening to this, you're probably doing the mental math right now. You're thinking, great, I'll just pay myself a W-2 salary of $1 and take $99,999 as a tax-free distribution.
Exactly. Why wouldn't I do that?
Because the IRS knows exactly what you're trying to do. We have to bust a very dangerous myth here. You will see people online talking about the 60-40 rule.
Right. The idea that you can just blindly assign 40% of your profits as salary and 60% as distributions to avoid audits.
That is a complete myth. The IRS demands that your salary be based on real market data. You need to ask yourself, what would it cost to hire someone off the street to do your exact job?
So you have to use actual Bureau of Labor Statistics data to justify your salary.
Yes, because if you get greedy, the penalties are severe.
Yeah, take that real-world cautionary tale from the sources of an accountant who made hundreds of thousands of dollars in profit. He decided to pay himself a meager $24,000 W-2 salary while taking $220,000 in tax-free distributions.
And he was heavily audited. The IRS looked at that and said, look, no accountant making $250,000 a year has a market value of $24,000.
Nope.
They reclassified his distributions as wages and hit him with massive back taxes, penalties, and interest. Your salary must be defensible.
So just when you think you've mastered the S-Corp strategy, the rules of the game completely change. And this brings us to the 2026 tax landscape and the One Big Beautiful Bill Act signed in July of 2025.
Very important shift.
Now, quick note, regardless of where anyone sits on the political spectrum regarding this specific legislation, our job today is purely to look at the mechanics of the law as it's written. We aren't taking sides, we're just reporting the facts because it fundamentally alters the math for every single business owner listening.
It's vital to understand these mechanics because they introduce permanent shifts to the code.
Yeah.
The biggest one is the QBI, the Qualified Business Income Deduction, originally under Section 199A.
Okay.
The new bill makes this permanent. In plain English, this allows most LLC owners to deduct 20% of their business profits right off the top before income taxes are even calculated. It's a massive freebie.
But here is the S-Corp twist that completely scrambles the strategy we just talked about. The W-2 wages you pay yourself through your S-Corp do not qualify for that 20% QBI deduction. Only the remaining business profits do.
Exactly. This completely shifts the math. In the past, the goal was simply keeping your salary as low as legally possible to avoid self-employment tax.
Right.
But now, it's a teeter-totter. Every dollar you shift to W-2 wages to satisfy the IRS is a dollar that instantly loses that 20% QBI deduction. It requires a much more sophisticated optimization of your salary versus your distributions.
It's a high-wire balancing act. You want your salary high enough to avoid an audit, but low enough to maximize your 20% deduction.
Precisely.
The new bill also made 100% bonus depreciation permanent, and it increased Section 179 limits to $2.5 million.
Yeah.
This means if you buy heavy equipment or machinery, you don't have to write it off slowly over 10 years.
No, you can deduct the entire massive cost in year one, instantly wiping out your taxable income.
The legislation also introduced several temporary individual deductions that alter the broader tax picture, right?
Yeah, for instance, there is no tax on tips, no tax on overtime pay, no tax on car loan interest up to $10,000, and an additional $6,000 deduction for seniors.
It's a totally new rule book. But here's where it gets really interesting. What happens when the federal government is handing out these massive deductions, but the state you live in refuses to play along? It's like playing a board game where half the players are using an outdated rule book.
You've hit on the concept of static conformity, which creates what we call phantom income. It is perhaps the most terrifying hidden trap for an unaware business owner.
Oh, yeah.
Not all states automatically update their state tax codes to match the federal government.
Let's use the state of Georgia as an example to see how dangerous this is.
Good example. Georgia only conformed to federal tax law up to January 1st, 2025. Because this new federal bill was signed in July of 2025, Georgia's state tax code essentially ignores it. The new federal laws just don't exist in Georgia's eyes.
So imagine the nightmare scenario. You have a great year, and you buy $500,000 worth of new equipment for your business. On your federal taxes, you use that new 100% bonus depreciation rule. You deduct the full $500,000, and let's say it wipes out your federal tax bill completely. You owe Washington $0.
Yeah.
You're popping champagne.
Until you file your state taxes. Because Georgia's code is locked at January 2025, they do not recognize that July legislation. They do not allow that $500,000 massive deduction.
Oh, man.
From the state's perspective, you have to add that $500,000 right back into your taxable income. At Georgia's state tax rate, you are suddenly hit with a $25,950 state tax bill.
A nearly $26,000 tax bill on money you already spent on equipment. You don't even have the cash in your bank account anymore. That is phantom income at its absolute worst.
It can bankrupt a business overnight. If you live in a state with conformity issues, the solution requires a very specific maneuver. The PTE, or Pass-Through Entity Tax Election.
What does that do?
This is a workaround that allows you to pay your state income taxes at the business entity level rather than passing them through to your personal return. By doing this, it becomes a federal business deduction, completely bypassing the $10,000 SALT state and local tax cap limit.
Wow. It just proves that you can't just set up an LLC, buy a laptop, and wing it. The stakes are way too high.
If we connect this to the bigger picture, the absolute necessity here is flawless documentation and proactive tax planning. You cannot wait until April to figure this out.
No kidding.
The data shows that a healthy business owner must consistently set aside 25 to 35% of their profits purely for taxes, while retaining at least 3 months of operating cash in the business account simply for survival.
You have to respect the mechanics of the machine you've built. Which brings me to a final thought I want to leave you with today. If you step back and really think about it, the tax code isn't just a punitive list of rules and penalties.
Right.
It's actually a secret map of government incentives. The government is literally handing out massive discounts to people who do what it wants, creating jobs, investing in equipment, and stimulating the economy.
That's a great way to look at it.
So the question for you to explore on your own is, instead of just asking, how do I avoid paying taxes, how can you align your next big business idea with the invisible currents of what society is actively trying to incentivize?
This raises an important point about how we view entrepreneurship itself.
Yeah.
You aren't just building an isolated business, you are participating in a highly engineered economic ecosystem.
Exactly. Understanding the rules is how you thrive in that ecosystem. Thank you so much for joining us on this deep dive. Remember, taxes might be the single greatest expense you ever pay in your lifetime, but with the right map, it doesn't have to be the one that sinks you.